Welcome to another episode of Rate Ready Radio, where we talk about real estate trends for mortgages and what's happening in the market today. I'm joined today by Rich LeMoyne, one of our top teams here at Mortgage Financial Group. Welcome, Rich.
Thank you for having me.
So today's topic is what's been on everybody's mind, and it's interest rates. It's Fed Day. So if you're watching this, today is November 7th, 2024, and it is Fed Day. So we're going to talk a little bit about what does that mean with interest rates. So what do you think, Rich? What's going to happen today?
Well, we already know they're going to cut it. They're going to cut it 25 basis points. Market has already priced it in there, so realistically shouldn't be any shock to the system or volatility. Bonds have been selling the way they're supposed to sell prior to this, coming off the election.
Yep.
The big question on that really is how's that policy going to be implemented? What's that going to look like? So for short term, looks like we're going to have the cut obviously today and going forward. Probably means rates are going to go up a little bit on the mortgage side.
Yeah, I would agree with you. I think there's a lot of misunderstanding in regards to what the Fed rate does, and I can't tell you how many phone calls I get. I'm sure you get them, that when somebody says, "Oh, the Fed cut the rate, so the mortgages must have gone down." And I know last time they did it in September when they dropped it 50 basis points. Or 0.5%, basically.
Mm-hmm.
The phone call came in, I want to cut my rate, and try to explain to them, no, they didn't go down, and now they've actually gone up since then. And so that's one of the things that I want to try to get people to understand today, that the Fed rate is not mortgage rates, right?
No, it's short-term lending between the Fed and basically your banks for short-term coverage. So that's what they're after on that. Yes, there is, the hope that it'll trickle down to the consumer side and the bond side, but that has not happened.
Right.
With the state of the economy and where we are with inflation, because there's other factors that go into your interest rate, not just simply one thing.
That's right. Yeah, and mortgage rates are a mortgage-backed security. They're a traded item, right? So they follow the yields more than anything.
Correct. And so they have gone up. I mean, yesterday, when it looked like we knew who was going to win the election, boy, they went vertical. They went vertical.
Now, and that's based on policies.
Yes, that's based on excitement. Yeah. I mean, that really was an excitement move from the market. And so the market went up big yesterday. I'm sure today it'll correct itself a little bit.
Yeah, we've seen some correction this morning. Mm-hmm. We've seen some.
And then, obviously, today's Fed Day, like you've already said. So, there was a little bit, I wouldn't say anxiety, because I think we all know what's happening. So we'll just keep on going, and I think right now we're kind of just in a short-term look. We're not really long-term yet because, like I said, his policy's got to come into place, what he's going to do, his 100-day agenda, how he's going to implement it. The market will start to adjust as it starts to become more apparent on what he's going to do as we get a little bit closer to those days in his inauguration.
Yeah, no, I totally agree with that. The interest rate markets, the treasury yields and the bond yields, they've already set the market to have that quarter point drop by the Fed today. So when somebody sees that the Fed's going to cut a quarter point, that's not what we're ever interested in. We've known that for weeks now, that what that number is going to be.
Right.
It's all about the statement, right?
Mm-hmm.
It's all about the statement after. What does the Fed chair say in his statement, and what did they all agree upon, and was it unanimous, and where do they lead us to believe is going to happen next meeting? And so that's one of the things that we really try to focus on is that statement. And I've got people that break it down that I read about, that I show you, okay, this is the last statement and this is the new statement. And they break down every single word, was, is. Something simple as a 2 or 3 letter word can make all the difference in the world on what happens with the bond market.
Oh, it's amazing on those letters like you're talking about where they break it down. I mean, they're literally crossing out words and saying, he said good, he said great this time. And it's all about the confidence or lack thereof confidence that they interpret coming out of that.
Correct.
And so hopefully, the statement is good and, positive, and the market reacts and the economy just starts spinning and, we can get going.
And the Fed rate adjustments, the Fed is making adjustments and lowering rates based on the idea of inflation conceptions, right? So they're looking for an inflation rate of 2%. Mm-hmm. And they're going to cut until they feel that the economy is in that position to where it's going to be there. The problem with that is every time they do something, it seems like the unemployment numbers or the employment numbers come out against them. Mm-hmm. And it seems that the economy is trying to hold on to whatever it can. I know last week we discussed when Cole was here, we discussed a little bit about how much the employment numbers were at 13,000, and so that's actually something against the Fed making that cut. But we're pretty sure they're going to do it. In fact, I think if I remember right, it's about a 98.7% chance that they're going to do that. So you can put your money on it; it's going to be pretty safe. So that's one of the reasons why we want you to understand that the Fed cutting rates does not directly affect mortgage rates. It is an indirect effect. It's going to have an effect because it's going to affect bonds. And if anybody ever wanted to watch what's happening with an interest rate, look at the 10-year Treasury bonds. That's where the numbers will come in. If they're going up, the yields are going up, rates are coming up. And you can see that right after the election, right? That night, I think the yields at the time were like 4.27 and they went to 4.44 almost instantaneously.
Yeah.
And so, that is where, as a consumer, as a home buyer, that you have to be watching. Don't worry about what people are putting out there for interest rates on the internet. Don't worry about teasing rates. Don't worry about those things. Look at the Treasury yields, and you'll be able to make your own decisions and see what's happening in that marketplace.
Right. The one thing is when you see those Treasury yields, that is actually not the interest rate. So like right now, it's 4.3. That's obviously clearly not the environment. There is adjustments that go on top of that for investors.
Sure.
They have to make their money.
Yeah, and that's what the MBS is all right. Mortgage-backed securities are all about, right?
Correct.
That's what they're about. The investors want to make money. They have to make money, so they're going to trade interest rates, and that's what they're going to do.
Exactly.
And so that's why it's a follow. It is not an exact science.
Correct. And if you look at the interest rate diagrams, the charts. Along with the 10-year as they go up. I mean, they simply do this all the way through. It's it's amazing. It's a great correlation for you to follow.
It's very rare they separate. It's
correct.
Very, very rare they separate.
So, that'll give you an idea if rates are going up, rates are going down, or just staying flat for a period of time.
Yep.
But again, that is not your interest rate. That's just a guide.
So without getting too in depth into what the actual interest rate is today, I can say that the rates, and part of the reason is APRs, annual percentage rates, and things that the government makes us disclose. But the rates today are about where they were in May, April or May of this year. So when the cuts happened in September, and we saw that small drop for about 3 weeks, maybe 4 tops.
Correct.
Where the rates got really good. We actually even did a couple of refinances, which was kind of nice. Those rates are all gone. I mean, the boat has been sailed. So the question comes in then, what does a buyer do in a market today for interest rates? How do you combat having to put a buyer, especially a first-time home buyer, into a payment of $2,200 or $2,300 a month? Again, we're talking Central Florida here.
Yeah.
When not so long ago, those payments were $1,500. How do you get them to that position where they're qualified for that payment? What do you do as a loan officer to help them get there?
Well, the first thing you do is we got to get them pre-qualified. We actually have to see what the real numbers are instead of playing a hypothetical game. So when I've talked to customers, I explain to them like, hey, let's fill out this application. Let's get a soft pull on your credit so we know what that looks like. Let's get some pay stubs and tax returns, depending on if you're an hourly worker or self-employed. Let's get real data. Then at that point, we can see what you qualify for. Do you qualify for USDA, a zero down loan? That might help offset some of that. Possibly a better interest rate. FHA, lower down payment, possibly a better interest rate. Or do you have to go conventional? If those become the options that you're working off of, RVA, at that point we can then figure out, okay, this is what the payment is, this is where we are, and do we fall into a case of maybe a down payment assistance program, or do we have to go outside the box to possibly a bank statement loan? Everybody has a unique situation. So we got to figure out what that is, but we need the real data instead of playing a hypothetical. Because when you play the hypothetical game, as well as I do, it usually doesn't pan out the way we want to, or there's a bug in the system there. So let's figure out what that number is, and then we can then go off of your personal budget. So you may think you can afford $2,000, but all of a sudden that payment's really going to be $24,000. Yeah. Can you really afford $24,000 even though you're qualified?
Yeah.
Or is that going to eat into your lifestyle? So we got to get those real numbers to get into a program that fits for you and your situation.
Yeah, I totally agree. And part of the problem is when you see the things on the internet and people are out there and you'll hear the news talk about this. Well, the interest rate today, the 30-year fixed rate today is 7.04% or whatever they decide they want it to be. And they're going to put that rate out there. That is an unadjusted rate.
Correct.
So that is the pristine borrower with the 840 perfect credit score and putting $100,000 down, et cetera, right? So the average borrower who's sitting at a 720 or a 680, or again, you talked about different loan programs, and depending where your credit scores are at, those loan programs will be more beneficial or not beneficial. We look at it from a position where they have to understand that there are risk factors that are going to be built into the interest rate, depending. Are you putting 5% down? Are you putting 20% down? Is your score a 780 or is it a 605? Doesn't mean we can't do the loan. It just means that there are going to be a limited number of programs that we'll have for you. And one of the things that I think I've been seeing in the market, I'm sure you've been seeing this too, is realtors negotiating for discount points.
Oh, yes.
And discount points, so for our consumers, so discount points are a percentage of the loan amount used to purchase a lower interest rate, to adjust some of those what they call loan level price adjustments to lower them and to offset them so that the rate is lower. So when you talk to a client, how do you talk to the client about maybe they should pay discount points, maybe they shouldn't pay discount points in order to work that rate? How do you work through that on the client?
So it kind of depends on each individual one. So one, do they have reserves of their own? Because if they have reserves of their own that they possibly could use towards closing costs, then hey, we can look at buying down those discount points. It might make sense. Or do they need those discount points that were negotiated actually to go towards closing costs so they can help them close the property? So we got to look and see where they are in cash position. Secondly, where is their confidence in the marketplace? Are they, and how long are they going to stay in the property? Like you can put, say, 2 points, just so what a client would mean. So if you're borrowing $300,000, your loan amount's $300,000. 2 points is $6,000. Right. That does not mean when we say 2 points that your interest rate is down 2 points. No. That you're probably looking at maybe 3/4 of a point at that. At best, right? So we got to factor that in. How long are you going to be in the house? Well, I think I'm going to be in the house for 3 years. Okay. Well, you're not going to break even if you spend that money. So therefore, maybe we don't use it towards buying down your rate. We just simply use it for closing costs to save you cash. So everybody has a unique situation. What works for you? And that's everything needs to be tailored towards you. There are no two files alike.
No, that's totally agreed on. You look at it from the standpoint of, like you said, there's no two files are alike. And we're not just loan officers. We're not mortgage lenders. We are financial advisors. We have to be. It has to be the broader picture. Is this your second house or your third house? Is this the final home? If it's the final home, you pay as many points as you possibly can, get the rate down as low as you can. Or because adjusting an interest rate as opposed to taking use $6,000, adjusting an interest rate by buying the rate down 3/4 of a point as opposed to putting $6,000 more down on a house, the payment difference in the interest rate side is astronomically different.
Significant.
Than using $6,000 towards a down payment. And so, especially over a 30-year period.
Correct.
So, yeah, I think you're absolutely right. I think it comes down to an individual's financial situation and their requirements and what they're trying to do. So, I think that's a good point to be made. And, rates are very interesting, especially on Fed days and when we're coming up on that. I mean, we have the Fed day today, the statement will come out tomorrow, and then next week it's all kinds of data, right? Inflation data and all things. So there's a lot that's going to be happening with interest rates over the next, say, 3 months even, right? In past January 20th and getting into, like you said, the first 100 days of the new president's term and trying to get into that situation to figure out where is the time to get off the fence or not. And I think what's happened is there have been so many people that have been sitting on the fence for so long that they keep missing that boat. And I think they have to get a better handle and an idea of understanding that don't sit on the fence anymore. Jump in the water. We can always refinance it later. We can always get you out of the loan you're in if the rates come down, but we're not anticipating that for a long, long time.
Right. So when I'm talking to clients, everybody's hoping that the first 100 days or so, like, the rates are going to be 5%. Not happening.
No.
But what you can do, and it's a little phrase that's been coined in the industry, which is, marry the home, date the rate.
That's right.
And so, because once this market does take off, anticipation is at some point it will. We just don't know exactly when.
Correct.
House values are going to go up. If your house value goes up $20,000, $30,000, $40,000, and that's what you spend, like that's a significant amount of money when we're talking about a 30-year mortgage that you're going to pay. So if you can get into the property, and then when rates come back down, when that happens, and refinance, you're going to have the equity to buy down some more points, plus the rate's already cheaper. Like you're going to save thousands and thousands of dollars. But if you're on that fence and you're waiting, you could literally outprice yourself from the market. Even though the rates are cheaper, but they're going to be offset, folks. As the house prices go up and rates go down, it just stays in the middle.
Also gets that supply and demand going too, become the seller market again or a buyer's market.
Yeah.
And there's a lot of factors that play into it, not just interest rate. And you could, like you said, you could hurt yourself on $100 a month. You could hurt yourself more by sitting out there. So if you're on the fence today, you need to get off the fence. You need to jump in this market before it gets too far out of hand. We've been seeing increases, and I think we're going to see some flattening of values. I know there are some markets I've been reading about. There are some markets that the values actually start coming down a little bit.
Correct.
This is not going to be at least I don't believe there's going to be a major cycle push here where the market is going to absolutely crash. I don't think that's going to happen. I don't anticipate that happening, and I'm not advising against that.
Right.
So, we're looking at a position where buyers, especially first-time buyers, there are programs available. Like you said, USD at 100%. There are bond programs. There's down payment assistance programs. There are ways to get people into a home that they can afford. And let's face it, buying a house even today is probably still cheaper than you would have to pay for rent, depending on what you're getting.
Or at least
at least you're building equity. At least you are gaining that. And like you said, buying it now versus when the market does make that shift, then you gain that equity, not somebody else. And so I think it's important for buyers to understand that it's not all about the interest rate always. There are a lot of factors that have to go into this. And as a loan officer, as a good loan officer, right, or even a great loan officer, it's a position where you have to advise that client, and they need to understand that some of that advice is really good advice they need to take.
No, absolutely. So, let's go back 3 years. The market was hot. Everybody's buying, everybody's refinancing, everybody's getting to do what they want to do. What happened to a lot of those buyers, and they can attest to it? They put an offer in on their dream home that they found. They didn't get it. Then they put in an offer on their second dream home that they found. They didn't get it. They put it on 2, 3, 4, or 5 offers, and then finally they kind of somewhat settled because they not waited, but they did wait to see what they can do and where the market was going instead of going ahead and investing in the property. And then when their interest rates went down, capitalizing through the refinance. So a lot of people lost out on their dream home. In my opinion, I think there's a lot of people in houses that they don't want to be in right now because I get those calls all the time. Look, we were
settled.
We were ready to sell, and then COVID came, and we weren't sure what was going to happen. And then the interest rates went down, so we refinanced and decided we're going to stay in here. We're going to fix it up a little bit. We'll cash out some equity and buy some toys, whether it's 4-wheelers, campers, take trips, whatever the case was. And now they look around and they're like, we're ready to move now. Even though we thought we were going to be here for another 10 years, we're ready to move now. We're just simply waiting. I would, depending on your personal budget and what's going on in your life, you may want to look at it right now. Because like I said, marry the house, date the right. You might be able to get into the house you want and then, save some money down the road.
Yeah. There's so many people that don't look at it from that standpoint. And there's also a lot of people that are still out there sitting on 2.5% and 3% interest rates that
fair enough.
They don't want to go anywhere. And I can understand that, you're not going to get that rate, and the chance of those rates coming back, they're not good.
Right.
I don't believe they will ever come back that low. They held them too long, too low, too long, and that's a whole nother conversation for another day. But right now, again, we talk about the buyers that are sitting on the fence and trying to figure out what they want to do. It's the time. Now is the time to do this. And so get off the fence and get in the market before it's too late, before you miss out on everything, and before the market turns away from where you want to be. Because I've seen people have a payment adjustment of $200 a month just because they decided to wait a little bit regarding interest rates and things like that. I mean, I had some people that waited when the market started coming down a little bit. They still wanted to wait just a little bit longer, and it turned really quickly on them. So
another part that's going to happen is right now you have a little bit of negotiating power.
Yeah.
The market's obviously not taken off, so it's not hot. So if you want to somehow negotiate a roof into the thing to help bring down your insurance payment, you're going to have that opportunity. If the market takes off, the sellers aren't going to have the appetite to replace a roof or put it in there. They're just simply going to turn it over to you. So at that point, it becomes a $15,000, $20,000, $25,000 issue that you get to solve versus maybe negotiating that up front right now when you have a little bit more leverage. So that's another way to look at it. Sure, I'm paying a little bit more in interest right now, but I don't have to put on a roof for another 15 to 20 years.
Yeah.
That's a huge savings.
I've got a client right now. They just went to contract yesterday. I got the contracts, and sure enough, there's a roof in it. The seller's putting a roof on the house. It was a full price offer. It's probably still a good deal, but he's putting a roof on it, and he's paying $5,000 in closing costs. Right.
So there's negotiating power for the buyer right now. So that's a huge savings. So let's just say that roof is $20,000 and he gets $5,000. I mean, that's a $25,000 savings to him. And then, like I said, whenever rates come down, refinance, and he really had a great investment.
Yeah, and that's the inventories, right? It's all about the inventory. We started to see that increase. So as the inventories go away, as there are less houses on the market, then obviously the sellers can demand more. As there are more houses on the market, they can demand less. So there's your seller market versus your buyer's market. And I think you're right. I think right now we're still in a little bit of a buyer's market. It's not huge, but it's there because inventory levels have come up and houses kind of stagnated when the rates went up. And so that's what we're seeing. Of course, again, minus the last 4 weeks that happened where we had that drop. It was a significant drop. I mean, we put people in the rates at in the fives.
Yeah.
And so it was a good significant drop. Unfortunately, it's gone now, but we'll see. It'll be back. It'll be back. The question is, well, how long it'll be back, right?
Right.
For sure. So I know you've been doing this with 17 years.
Yes, sir.
Oh boy. And all with us. So we're proud of that. You are our longest tenured loan officer. So we appreciate that. So tell me a little bit about Rich LeMoyne and his business and what he does to make the consumers comfortable and give them the advice that they do.
So started in roughly 2008 with Mortgage Financial. Got into the market just literally doing my first loan when the market crashed. Like that, what a great time to get in. Actually turned into
it was fun back then.
It turned into a major blessing because as the market was crashing, there were so many loan officers jumping out because, it became a hard environment to make money. Mortgage Financial happened to be very, very good and equipped with USDA. And at the time, home prices were significantly cheaper. I mean, $100,000, $120,000 loans were kind of where we were living. And USDA with the maps, we were able to do them all day long. So I was able to learn the business while everybody was getting out, kind of like build it. Crafted some of, the sales techniques, so to speak, of understanding what the products are, how to explain them to the buyers. Because in reality, part of the job is education to the buyer. Especially first-time home buyers. They understand some and they get advice from other people that may or may not be good advice because that was their experience. And like I said, every file is different. Yeah. What happened to them may not happen to you. So I've learned how to explain that, talk to them, make sure that they understand that I am available. Yeah. Call, I don't care what bank you want to name, call that bank at 6:30 tonight. See if they
good luck.
Yeah, see if they answer you or they respond to an email and or a text. That's kind of our niche here at Mortgage Financial is we are flexible. We are a local bank in the sense that we can move. We have flexibility. We answer the phones on the weekend. We can get you the pre-approval letter. We can explain to you what's going on. Okay. And that's kind of what I've worked off of the years while trying to develop relationships with different real estate partners and different things like that. Just building goodwill in the industry, priding myself on trying to do the right thing.
And that's important. That statement right there is an important statement. It can't be about making money all the time. Look, obviously we're in business. We want to make money, folks. I mean, we're not going to hide from that act. But it can't be just about that. especially with a first-time home buyer. One of the things that Mortgage Financial prides itself on is in 2008 when the bust happened and everything went sideways, we didn't have people lose their houses. People didn't lose anything because we didn't put them in loans that they didn't agree with. Back then, they had the option arm loans where you could pick your payment. We didn't do those loans because I didn't believe in those loans back then. And no, we weren't making millions of dollars, but we were making a living. And I know that the people that had houses through us, that got mortgages through us, were in payments that they could afford and they could survive through. And that's one of the things that, again, it matters. You have to be there for the client every step of the way. And they're going to ask a lot of questions. Oh, yeah. Right? They're going to ask a lot of questions. You got to be able to answer those questions. You got to have the patience to walk with them through this. And that's one of the things that I see you do with your clients. And I hear that on reviews and when I get to speak to clients. I appreciate you taking the Mortgage Financial brand and doing that, not just the Ritz LeMoyne brand.
Right.
So...
I mean, little fun fact, I purchased a home in 2003, for me and my wife, Judith Ann. And know who the loan officer was on that?
My father.
It was your father.
Yeah, that's right.
It was a different company at that time, different name. But I called him on a Sunday night. He was driving. I don't know where he was driving to, but he was driving. He pulled off to the side of the road, and said, I just told him, hey, call me back tomorrow. I just wanted to, get on the list. And he said, absolutely not. We're doing it right now. And, by the next morning we were pre-approved and we were able to get our house. And, that kind of laid somewhat of a foundation to when I got into the business, 5 years later, of, take care of the customer. They are valued.
Yes.
They need to be educated, explain to them. Yeah. It's not just transactional in the sense of, we're here to make money. Because there's a lot of people, and we get loans from other companies that people are like, I literally just felt like, a bait and switch. They just wanted me in there. We part of the job is, like I said, it's education.
You will never be a number with Mortgage Financial.
No,
ever.
Absolutely
You'll never be a number. You're always a name. We're always available. We will answer every question 100 times if we have to.
Yeah.
Because that's our job. That's what we are supposed to do. That's what every loan officer is supposed to do. And there are good ones out there other than Mortgage Financial. I'm not saying they're not, but I think we do it really well. I agree. So I do know that you are going to be going away this weekend.
I am.
So for those of you that don't know, I am a Florida State fan. Yes, I will still admit that on the air with my 1-8 season going. And Mr. LeMoyne here is a Notre Dame fan, so I'm not really looking forward to hearing from him this weekend. But
yeah, we're gonna go up and watch the game. Notre Dame, Florida State.
Congratulations on your win.
Hopefully that prediction comes true. And but no, it'll be a fun time. Going to go with my wife and 2 children, and just have a little bit of relaxation and enjoy the environment, and hopefully come back with a win.
Well, hopefully Florida State can spoil that for you. I'm kind of not counting on it, but hopefully we can. But hey, again, I want to thank you for your time, Rich. I want to thank you for everybody out there. Again, remember, it's all about your file in particular. Rates do matter, but to a point. So make sure that you speak with the loan officer, speak with Rich. You can contact him. His information is up on the screen back behind us. You can talk to him, and he will answer questions to help guide you to get off of the fence and get in the market today, because now is the time to buy a house. Again, I want to thank you for watching our episode of Rate Ready Radio. And until next time, we'll see you soon.